All right, what's up, everybody? Fed time. FOMC time. All right, we're going to talk about how we trade this, how we look at this. There's some tricks to it. We all know it's going to be 25 basis points. All right, let's draw a crowd. Can you guys hear me? What's up? Am I unmuted? All right, let's go. All right, I'm gonna have to like. Let's draw a crowd. All right, everybody, welcome. All right, let's start talking about FOMC happens in 3 phases. You're gonna have the first 5 minutes. Okay. You're gonna have a knee-jerk reaction. You're gonna have minutes. You're gonna have a second wave, about 15 to 30. And then at the press conference, is when the actual magic happens. Press conference gets pretty nasty, okay? Echo, echo. You can hear me twice. You shouldn't be able to hear me twice. Check the audio. Only you probably have me playing in 2 locations. So it's very likely we're going to get 25 basis point. The question is, how is the market going to react to that, right? So we're going to look at the press conference. I'm going to look for places to trade inside of that environment. So everybody get ready to watch this. Hold on. Hey, Jordan, which monthly map are you looking at? Oh, EMPH. Ooh, okay. So EMPH, that's showing not bullish, not bearish, and very liquid. So it's about to become more volatile in both directions. If you look at them, the slope of the bull side is stronger than the bear side. So basically means bulls are leaving faster than the bears. But in volatile environments like that, it's neither bullish or bearish. If you had to make a judgment call, it's slightly more bearish, but again, it's flat and volatile, so it can go any direction. Short term up, short term down. In general, though, you want to see the bull side sloping down for bulls to be stronger, and the bear side sloping up for the bears to be stronger. So yeah, you're pretty much consolidating, and it's probably going to be consolidating for like another week on that one. All right, what up, you guys? All right, okay. He's talking about some EMPH. Yeah. So if you look right here, what you want to see, and it's keep a note on where monthly hedge pressure is. Now, FOMC happens in 2 phases. They're going to come out with the announcement, and we're always good at predicting what it is. The FOMC is going to raise or lower the interest rate. They're likely not going to, let's go to this, FOMC. Okay, so the interest rate decision, if you just go here real quick. I'll let it load up. As you see, we've been sitting flat with no rate hike at 5.25 funds rate. Okay. If they continue to raise, the question is the market already pricing in that bearishness? We've been slowing down the bull run, anticipating a rate hike is my thought. The market's always priced it ahead of time. That big, large bull run that we had that kept going really strongly, right? Has slowed down over the last week or so because I think they're pricing in that bearishness already. So the idea is that the FOMC decision comes out, the market's going to move in a very slow sort of fashion. That's typically what you'll see. Is that immediately when the knee-jerk reaction happens, it goes one place and comes back. Now, here's what you're going to look for. Everybody look at my screen real quick. If the instant, whatever the price is before the event happens, wherever it goes, as long as it returns back to where it started, the decision was priced in. That's how you take it. So wherever you are, no matter what it does, if it just stays at the same price or moves and comes back, then the decision has no effect on the market going forward. It's already priced in. We all got it? The next step is what happens in the press conference. The press conference is like forward guidance on rates. They're going to talk about where they see the economy going and what the future is likely to look like. The press conference is really the big mover. So the knee jerk is all algorithmic. Nobody trades in the first 5 minutes like I'm showing. Nobody does. It just typically, unless it's a shock, it does not pick a direction. The press conference is the shock. 98% chance we're going to get 25 basis points. So 98% chance the market's already priced it in. And the reason that over the weeks we've been kind of settling a little bit, actually still trading higher, the speed of the rally has slowed down, probably pricing in the rate hike already. If there wasn't a rate hike, we would have been accelerating higher already. Do y'all see that? So efficient market hypothesis states that the available information is already priced in with the 98% certainty. It's already priced in. The press conference is going to guess what happens next time. If we're 25 basis point now, then it might be likely that we're 25 basis point again. If Powell comes on the press conference and starts talking and says, we're not going to raise rates anymore for the rest of the year, you can imagine that's going to be the bullish thing. So what we do is you can either watch the press conference live, or you can get out your financial juice, which is what we love to look at here. It's a news aggregator, and all of Powell's important words during that press conference. That way you can listen to music and not listen to him talk. Will show up in red, and you'll see what it all is. We're going to be looking for signs of him talking about improving labor market, signs of improving inflation. These are things you want to hear him. He's going to recite the same script he always does. But the really important thing you're looking for is any hint that they're going to speed up rate hikes or slow down rate hikes or cut rates or raise rates slower, raise rates faster. What do you think they're going to do next time a month from now? And the market is going to rally or sell off or do something based on the press conference more than anything. The 5-minute window is the knee-jerk reaction, and very rarely does that pick a direction. It has to surprise the market. If it was like a 50% chance that you're 25 and a 50% chance you're 50 basis point, that might move the market. If it's a 98% chance you get a basis point hike of 25 and he comes in and does nothing, the 5 minutes is going to be directional if it's a shock to the market, right? So in the 15 to 30, like that middle window, it kind of moves medium speed as well, and sometimes can pick a direction as people try to get ahead of the press conference. Sometimes news can leak or whatever. So the first part is the announce, right? The announce. The second part is possible leak or spec. Leak of press conference, usually something, or just bets before spec, pre 10 seconds, pre-press conference. And the next part is the press conference, which looks out a month. So typically you're going to see like a little bit of volatility, medium volatility, and then direction one way or the other in there. Let's see what we get. All right, market's dipping a little bit. Watch this hedge pressure right there. You see the news coming through here. There we go. 25 basis point, exactly what we anticipated. Hit that hedge pressure, came right back to where it started, and now you can see that there is no effect. It's effectively priced in. You can see right here, everybody come and look on a tick chart. All right, now he's going to start talking about what it is. Market's likely moving. And then you can see that, watch, don't do anything in the first 5 minutes. It's always a trick. Okay, does everybody see on my screen right here? This is exactly when the event came out. We dipped and came right back to it. Does everybody see? We returned to the price it started at. It was effectively priced in. That's exactly what we said is going to happen. We're so good at doing this. We've been doing it for years. Now, we're going to do absolutely nothing, but wait until 1:30. And then at 1:30, we're going to listen to the press conference and see what's going to happen. Watch. That's it. Don't trust anything in the first 5 minutes. See what I'm saying? Watch what it's doing. See those random candles up, random candles down? The market has achieved equilibrium and liquidity based on the answer. This is just algorithm expanding. The idea that we didn't even span a risk interval is exactly why you know it's not a catalyst. The market was not shocked or surprised by this, and we've only moved up 4 points off of that. So now the press conference is going to be looking towards the next month. And the question we have is, are they going to raise rates again and go forward? Now, rate hikes are not necessarily bearish for the market. They can slow down credit, and they can be bearish for the economy over a longer term period. And QT is more of the bearish thing that we would be experiencing. But in general, rate hike is not the reason. All the bears out there are like 25 basis point, market's going to collapse. The markets could very easily rally off of this because it already priced in the sell-off, and that's why I've been trading down the last couple of days. Now, one thing to take note is the liquidity of the market. As volatility is trading down, one of the most important things we teach is that volatility is the inverse of liquidity. And VIX is a measure of volatility. And as you see off of this event, and as the last 3 or 4 days, the VIX has been trading lower and lower and lower, meaning there is no perceived volatility, i.e. the market is adequately pricing in exactly everyone's expectations, right? So there are no surprises. So the FOMC is going to do absolutely nothing in the market, and VIX trading even lower is a great sign for this to have adequately been absorbed. And as long as Powell doesn't say anything damning in that press conference, we're slated to continue rallying for the next couple of days. That's my call. All right, hang tight. So we're going to wait for that press conference to come out. All right, so we're gonna see what we get, ladies and gentlemen. Sorry, that's it. How did I do? Look, first 5 minutes, I literally drew a box right here. The second 15 to 30, it's going to get a little more violent. At 30, it's going to run. How was my prediction for the first 5 minutes? Look at my screen, everybody. You typically, as long as it's priced in, you're going to bounce between the first two resistances you see. And as you see on Rocket Scooter, I drew them for you. Do y'all see how cool it is to actually learn how to trade FOMC? Typically, you just don't. If you want to set risk and reward off a hedge pressure or something, you can always make a trade. But in all honesty, when the expected thing happens, you just span volatility between two resistances. As we're trading below half gap, you can see that S&P resilience is positive. So we're slated to at least attempt to make a run for the day. As long as the press conference doesn't come out with some weird things. The anticipation was that we're staying in a nice tight range. How did I do on my prediction? Remember, I drew this at the start of the stream. When you do this long enough, it gets pretty easy. As you know, a shock would be what moved the market. There was no shock. As a matter of fact, the selling off over the last 2 or 3 weeks is effectively, not 2 things, sorry, the slowing down of the rally for the last couple of weeks is actually what was pricing in that rate hike already. You already see people getting ahead of that, taking a little bit of profit in NASDAQ, taking a little bit of profit in S&P, rolling into our IWM and things like that. That's not a wizard. I just do. It seems like it, because like when you see someone cast a magic spell, they just wave their wand and beautiful things happen. It's what makes magic so impressive is not that they can do something you can't, is that they do it simply. If casting a spell took an hour long to chant, we wouldn't think magic was cool. The fact that you do something simple and on the surface it's elegant, that's what makes it beautiful. We look at the market very on the surface. We don't go much deeper than we have to really formulate an opinion. I can't remember who said this, but they said a master of their craft is one who can explain their craft to an absolute novice simply and have them understand their craft fully. Meaning that if somebody has explained something to you and they have to go through hours of explanation to teach you, they haven't mastered their stuff. If they can deliver it to you simply with a very easy to understand analysis, it just means they've mastered what they've done. To be able to convert it to like an easier to digest kind of thing. Don't say I'm a wizard, just been doing this forever. We know what makes markets move. This is no surprise. Market's not gonna do anything surprising. It's gonna bounce between support and resistance. In reality, what's interesting is that, the simple approach, people that struggle in trading tend to, I guess, criticize anything around them because they're not really successful and they're not happy. And so people have a few people here and there have actually criticized my approach for not going deep enough into all these other, why are you bullish with this, and this? You're not even caring about that? And my answer is, I don't care about that. Well, how can you not care about that if you're a successful trader? Because it doesn't move markets the way you think it moves markets. And it's like, the thing that moves markets are very simple mechanics, very simple. And so we just make sure that it's a very simple explanation. Market's going to test buyers, test sellers, going to fall to a support, rally to resistance, and then end up in the middle. You expect that to happen when no one's surprised at the outcome. As humans, we're motivated by very simple motivators. They want absolute and they're playing a probabilistic game. Yeah, somebody last night was blowing up my comment thread with some weird thing. And I was like, positional data just shows. They were trying to say it was a short squeeze that's been rallying, and it's 100% incorrect. It's not even open to debate. You can literally go, oh, that's not. You can go to the Command of Traders, and you don't have to. You can't debate what is. It's not even up for discussion. It's not even my analysis. It's just displaying the information. The reason the market is rallied is because the asset managers, the net long institutional side of the market, has increased their exposure to the long side. They've been buying more and buying more and buying more. The person said, it's a short squeeze. It's a gamma squeeze. This is not a real rally. And I go, well, let me teach you something, homeboy. The shorts are actually more short over the course of the rally than they were at the start of it. The shorts haven't even begun to squeeze. This is not, he's like, I don't agree. I'm like, how can you not agree? This is not even my interpretation. This is the fact. This is what is. I'm not even interpreting this. I'm literally just showing it to you. This number is smaller than that number. I disagree. That's literally what he was saying. I'm like, okay. I feel like these people sometimes are so stuck in their ways and so buried in an upside down position, they don't want to learn anything because they don't want to be wrong. And that's the problem traders have. You don't want to be wrong, and you hold a position for the longest time. You don't want to listen to any kind of reason. If you sum up every single person who buys stock, and there's a box that's this big with like a bunch of people standing in it, and then you measure it, I don't know, a year later, and the box is this big with a ton of people standing in it, there were more people who long the market. If you own something and more people want to buy it, you're going to raise your prices. It's going to go up in value. As long as like you can't debate this, and somebody spent hours trying to debate this, and there's no debate. There was no short squeeze. These people do not short markets. The asset managers do not short markets. That category is a group of people who don't short markets. They're not the ones in that boat, like asset manager category. Institutional investors, pension funds, endowments, insurance companies, mutual funds, any portfolio investment managers whose clients are primarily institutional. This is your 401k is in here. Mutual funds are in here, right? Your pension plan is in here. Annuities are in here. Nothing that these people aren't out there speculating on the market. They are longing stocks for them to grow over the course of your career for 50 years, right? So the long becomes more long. Markets go up. The short has become more short despite the rally. There's no short squeeze. That blue line below zero, not over interpretation, it means short. The short position is negative 385,000 contracts short. For it to squeeze, the short would have to be squeezed out of their short. And as you see, it's happening in little burps, but overall, it is still sloping down, which means people are more short and more long. Very, very good. Very good question. If it were to be a short squeeze, what you would see is any of these categories that are short becoming less short. So if you draw like a zero line, if you're above zero, it's long. If you're below zero, it's short. A market crash typically is long selling out of their long. They let go of the market and it falls. A short squeeze are shorts letting go of their short. So the shorts would move towards zero. So once that short position starts becoming less and less and less short, people are exiting their shorts, i.e. a squeeze. An example, if you shorted the market and somebody, or say that you bought calls in the market because you were actually short the market. A market maker sold you calls because you're using them as insurance against your bear position. Okay, market maker sold you calls. Now the call seller is exposed if your calls go in the money, if your insurance pays out. So they got to run in and chase the market by longing in the direction of the rally up. And that is what's called, that's what creates a short squeeze. Because as they're longing, it pushes price even higher, which puts more calls in the money, which forces more call sellers to long, which pushes price even higher. More calls go in the money, and that chain reaction keeps going. The short squeeze is fueled by rapid exercising of contracts that bump in the next one, bump in the next one, etc. Or just people that are flat short a position, and they are getting out of the position straight up. You're short 10,000 contracts, and you cover it, you bought 10,000, not to long the market, but just to escape. But you're still buying against the sell side of the market. Any of those cases create a squeeze, and a squeeze is where, think of it the same way. You're standing on a moving train, or, and people are squeezing in through the doors, right? You're holding on to a little metal bar, at the airport, the tram that goes around, and people are squeezing in the doors, and they bump one person, they bump another person, they bump you. The first person didn't bump you, they bumped the domino effect that bumped you. That's what a short squeeze is. It's a domino effect that's created by the person before that squeezed through, right? Anyways, you have to understand that not everything. I mean, it's an obvious incorrect statement to say we rallied on a squeeze. We rallied on actual buying, right? Literally actual buying. Your 401k that was mostly cash and you know, fixed income investments has now shifted more to equities. You can see that risk being built right there as the market itself is moving. Here now we're in the 15-minute window of pre-press conference move. You can see it's slightly starting to trend higher, and that's just because the market is moving on the general pressure of a bear long up. We're trending higher. Resilience is greater than 0. It might want to run to the top of the box. All right, we're not afraid of that. Okay. Anyways, that's pretty much it, right? There's not a lot really to say until Powell starts talking. We got about 10 minutes till that starts happening. Or 13 minutes. My belief is still bullish on the market. Monthly maps will show that we're bullish. That wound up short position, I'm expecting to liquidate. And so I hope that we get some move today. Now, long up hedge pressure looking pretty good. Keep in mind, we're still irrational on NASDAQ. We're still trading outside of DD band, so just be careful. As you see, the NASDAQ selling off last week is likely pricing in the rate hike. That's the bear. That could be the bear wave of the rate hike. And that's exactly what you expect when that expectation is 98%. The market is accurately priced in that rate hike. And now this is a dip. If there are bulls out there, they've been waiting for a dip, they may choose to buy this. Or if there are bulls that are ready to get out, they may choose to sell. So anything can happen from here. I still like to err to the side of liquidity maps. DD resilience still showing everything looking great. Does res work in that kind of environment? Typically, yes. If you have, well, when you have hedge pressure breaks, resilience you got to take with a grain of salt. We always say when markets are irrational, resilience may have delayed effect, right? Like the index may be squeezing first before the stocks move. And resilience being 22 is well above that threshold of 10. So I still believe what resilience is telling me more than anything. Let's pull the liquidity map for a bear long up. You can see that open, blue, open is still pressure. Open, blue, open, blue, open, blue, open. 3 times it's moved. Any break above open trades the next resistance. Next resistance is the close. If you play the DD rule, the bull zone is likely to hit and come back down into there. We'll see. I can see today a res move to there. That And then anything that can happen from here. Remember, any catalyst that can move the market, you be very careful on, you know. So let's go back to the futures and see if we can't make ourselves, while we're waiting, we got 10 minutes. Let's go ahead and just quickly do an IRL, right? You boys and girls know how to do that. I hope. We have any one doesn't, there's not a good one that qualifies there. All right, let's go check NASDAQ. So there's one on NASDAQ. Does it pre-prep with your catalysts? Anything good? Oh, that filled too. Okay, so there's not even an impact off of that. So as you see, while the market did dip and move, there's no impact line inside of there. So we don't even have a possible catalyst event from here. The catalyst event could start. We have to measure this from the moment press conference starts. So everybody get Financial Juice if you like, or whatever news aggregator if you want. I personally don't like listening to the press conference. I honestly don't like listening to anybody talk about markets except for myself and my friends in spaces. So I actually absorb the information from Financial Juice. I let it just feed the information to me. Let's read some of that information. Let's see what the anticipation is going forward. Anything good? That recent case suggests economic activity has been expanding at a moderate pace versus a modest pace in the June statement. Who's been talking about the increased GDP, the better employment situation, the better wage situation, better PMI, better factory orders, all this other stuff right here. And Powell's reiterating that. See, we try to see what motivates the Fed more than anything. A more stable market allows the Fed to turn on the afterburners a little bit more. They had to stop raising rates to keep the market from collapsing. Right? The banking problem that pushed some bullish sentiment into the market. Okay. And now that the economy is doing better, they're going to speed up the car again and again play that balancing act. The vote in favor of policy was unanimous. This was probably expected. So futures put a chance of a rate hike in September, 18%, 36 in November. Probably a Fed hike was 18 in September for the statement. So very little change in the anticipation of what happens next month. If I had to consider extent of additional timing to curb inflation, we believe that they're going to have a higher for longer plan to really just nip inflation in the bud over a longer period of time. That's expected. They're not going to be able to control this type of inflation that easily. They're just going to have to keep pecking at it over time, and that makes a lot of sense. Okay. Anyways. All right, guys. Hedge pressure bounce on SPY. Let's see how we end up rolling from this. Now we wait 2 minutes till press conference starts. You're going to see the bigger volatility up here. So we'll see what we got. I'm snacking real quick, so I got the mic muted. I'll be done eating in a minute. Guys, press conference about to start. Let's start talking here. All right, my mic is live, everybody. If I'm smacking too loud, let me know. They're listening to it through the spaces, so you guys will notice that if you're using Financial Juice, your feed will update as Pal says more important things. Yeah. That's correct. Data dependent, meaning that they're looking at economic data, and that's a very dovish comment. Housing sector picking up. The full effects of QT are likely to be felt. You know, right here. It's as he's talking, the feed is picking up. All we're doing is listening for hints that they're going to raise rates faster, cut rates sooner. So the trick here is to guess from what he's saying how his behavior is going to be in a month, and that's what the market's going to move on. He just mentioned the jolts are coming down. Job vacancies have declined. We talked about that this morning. It's a little bearish commentary there on high PCE over the course of the year since February. That they're above their typical 2% target. It's pricing index. Pricing metric that is for inflation. Fed targets 2% inflation a year. Inflation's healthy. They try to keep it under control for 2%. So clearly with inflation higher than 2 or 3%, he's just acknowledging that inflation isn't at their target yet, and they're going to raise rates to get to their target. He's just reiterating a standard narrative about what inflation is. He's not saying anything. They're committed to returning the 2% objective. This is the purpose of the Fed. This is nothing new. So they're reducing their securities holdings as quantitative tightening. You're saying Powell is saying he sees the effects of QT on the demand in certain sectors of the economy, which is expected. That's what QT will do. It slows things down a little bit. Fed's not pumping money into all the sectors, or even, that stimulates things. They stop doing it, they destimulate things. We're just listening to the press conference if you're just tuning in. Market's bumping. Let's hit that close. Let's hit that close today. Let's get that DD pump to bull zone. Let's go, baby. Why did I draw it? That's supposed to be that's a messed up D. Questions now? Asking questions if more hikes are on the way. You haven't made a decision to go hikes every other meeting yet? So you're taking it one meeting at a time. Does everybody see how once Powell starts talking, this is where the real volatility of the market goes? You break out of that starting range. So every single Fed meeting, it's pretty much the same way. And when you trade enough of these, you just learn to do it. Imagine you making a trade this morning and sitting here all day to trade on some fucking gamble at 1:30, right? Do you know how important it is to just, if you don't get a trade within the first hour on Fed day, walk away and then come back at 1:30 and listen to that press conference and do something if it makes sense? That's exactly how I trade it every time. I don't hold a position through it to try to gamble. You'll see how it works. Watch. All right. Intermediate data came in broadly in line with the expectation. They suggest more hikes are needed. That's a judgment they will make. That's something we're not, you know, like I said, we don't have any, nothing he's saying is surprising. Let's go, baby. Let's run. Let's run. Taking profit. I'm closing all of it. My position out. 1160 profit. There we go. Let's run. I'm done with my day trade. Hit that DD band. Call it a day. That's how we run it. That's how it works. Exciting about that. All right, done. Love. All right, good deal. Let the market do whatever it wants to do from here, and I'm not going to really spend too much time trying to guess on it. Ready? That's 1160 profit on that run. Close everything out. I'm done. Not bad for 15 minutes worth of work, I guess. So I'm gonna call it a day. I love you guys. It's looking pretty good. Market's running up to upper bull zone. Like I said, short squeeze hasn't even started yet. Market is going to likely rally so fucking hard. I'm excited. Let's go ahead and watch this VIX decay out through the rest of the couple of days. I've got an entire month worth of bullishness, so I'm in no hurry to jump into anything today. It's okay, whatever, but hopefully we get a good run and see this thing continuing to go. Yeah, things are looking great. I want to see that volatility decay. It's exactly the prediction I have, that we would have no effect on the Fed. We would continue along the same trajectory after repricing in those rate hikes that we priced it in a week ago. Not going to price it in now. That they're going to raise rates as the data warrants, that they're going to take it a meeting at a time. What would have been really cool is to see them saying they're going to skip every other meeting. That would have been even more bullish for the market. But the idea that 25 basis points is not a category 5 hurricane. I know I made the meme to say that, but like I said, this is what I want to say. I'm going to close off with this. I know I made the meme. Feel free to go like the tweet, share it. Bears today on 25 basis points. It's like, look at this. There's a cloud. You see it? Hurricane. Everyone watch out. It's bearish. Bad news. It's not how markets move. Anyways, we got it. Love you guys. We'll see y'all later. Adios.